intended for US recipients only, and in particular is not directed at or intended to be relied upon by any UK recipients. Any information or analysis in the webinar, not an offer to sell or the solicitation of an offer to buy securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Session Capital Research. Session Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, let's dive straight into NVIDIA numbers and then we'll get to the stock. So by any normal standards, the quarter just printed was terrific. So this is a company with trading 12 months revenue of almost $100 billion, and it grew revenue this quarter versus the same quarter last year at 122%. So that is abnormal, to say the least, and just doesn't generally happen. NVIDIA is a one-time phenomenon at the moment. It's a generational stock. It's a generational company where you have a fundamental shift in the compute platform, and somebody has a monopoly hold on it. There are other companies that provide GPUs. You can buy them from AMD, you can buy them from Intel, you can buy them from 1 or 2 other places. You can develop your own in-house, but there's only one company that has the ability to ship them at scale that comes with a software instruction set that developers understand, and that is basically the industry platform for AI. Now that will change. It will get deflated away. When you see a company that has 60% cash flow margins and it's growing at this sort of rate, it has monopoly pricing, and everyone else is out to deflate it and come up with cheaper solutions to rain on its parade, and that will happen, but that's not today. Growth cooled, that's going to happen. So growth cooled from 262% last quarter down to 122% this quarter. That's going to happen. You can't keep accelerating revenue growth at the rate that they did through 23 and early 24, but that puts TTM revenue growth, so the last 12 months revenue divided by 12 months before that, still just under 200%, so remarkable. Gross margins are very high, 76% on a trailing 12-month basis. Again, that tells you about 2 things. One, their monopoly pricing, and 2, it tells you that a lot of the value in what they're charging for is software. Semiconductor companies do not have 76% gross margins, and the reason they don't have that is the bill of materials to produce a chip is a lot, and so a lot of what they're able to charge for here must be software. And it tells you again the lock-in value of the CUDA platform. Operating income down to EBITDA, 68% trailing 12-month EBITDA right now, and cash flow isn't very different. And the reason for that is that CapEx is limited. So this quarter it was relatively high, just short of $1 billion. Last quarter, $369 million. So it's not a high CapEx business. This is not an Intel with its own fabs. It's not even charging much in the way of internal software development to CapEx. Net working capital slightly negative this quarter. In general, they're pretty good at getting paid. So working capital on average, if you go back a few quarters, it's probably negative most quarters, but not too much. So that means that cash flow tracks EBITDA very closely, and that tells you that 2 things. It tells you that the profit recognition is probably accurate, and that tells you that the revenue recognition is probably accurate. If you ever worry about company accounting, the first place to look at is the revenue real? And the best way to check if the revenue is real is to work out whether the cash flow is real. And if the cash flow is real, probably the profit's real. And if the profit's real, probably the revenue is real. Balance sheet, $26 billion of net cash now, pretty much all cash, hardly any debt. And so fundamentally, incredibly strong balance sheet. Valuation, of course, as everybody knows, it's up to 125 now? 119 now. As everybody knows, NVIDIA is massively overvalued, except it isn't. So it's a big revenue multiple, 30 times trailing revenue, but it's a very high margin business. And so, yeah, if you look at that, you go, well, 30 times sales, that's insane. But 50 times cash flows is not insane for a business that's growing revenue at 122% this quarter, which has $26 billion in the bank, and which can sustain these very high cash flow margins. 60% is probably around peak. You can see it ticked up a little bit this quarter. Don't be surprised to see it come down to nearer 50%, even down to 40% as they have to invest in future product generations. Still a fundamentally superb business, and so I do not believe that this is overvalued on fundamentals. The stock will drop at some point. It'll drop because the market changes. It'll drop because a genuine competitor comes along, and even though the cash flow margins and the growth might be high today, the market will see that those margins will fall and the growth will fall as the competitor eats share. That will happen. It always happens in tech, and NVIDIA is just this generation's monopoly play on AI. Previously there were monopoly plays on data center and cloud. Prior to that, there were monopoly plays on client server. Before that, there were monopoly plays on mini computer or mainframe. There is always a monopoly play somewhere, and this is the current monopoly play. Monopolies in tech get eroded. Always happens, but I don't think it's going to happen tomorrow. So fundamentals terrific. Guide looks good. They're guiding to 80% growth. Again, it's coming down from this quarter to next quarter. Let's say they're guided by a little bit. They do have some product delays, so we won't get into that too much here, but the new Blackwell product looks like they have capacity constraints on that. Looks like they've got some shipment delays. I don't think that will stop customers buying. They'll simply buy the older product, Hopper, and they'll wait for Blackwell. There is, as everybody knows, an arms race in AI right now. I don't think it's a bubble. I do think it's real. I do think it's the next generation of compute. And I do think if you start to look around, you can now see large enterprises extolling the cost-saving benefits of AI in terms of labor-saving, cost-saving. The thing that always drives technology spending in the end is cost savings. And so if you can save, X thousand hours of labor by using a computer, why wouldn't you? Because a computer always shows up to work on time. It doesn't gripe about what's being served for lunch. It doesn't have problems with its co-workers, and if it does, you can get Dynatrace to sort it out. It's a much simpler way to run a business than to have people. So if you can automate something, you're going to. That's bad news if you're an employee. It doesn't matter whether you are, the bluest of blue collar laborers or the whitest of white collar skilled workers. AI is coming for your job. And so the best thing one could do, I think, is to work out how to use AI to accelerate your own job or business. We're starting to use it here at Cestrian. Why? Because, well, why wouldn't you? It's the new thing. It can automate tasks that we do. It can automate modeling. It can automate writing up notes. It can automate stock analysis. Why wouldn't we do that? As Cestrian grows, if the choice is hire one more person or rent some GPU time, that's a no-brainer. Rent GPU time. Why wouldn't you? So AI, I think, is absolutely real. Absolutely is the next generation of compute. Absolutely, we're just scratching the surface. And NVIDIA, again, is the monopoly play. Let's look at the stock chart and then let's stop for questions. Right. So let's look at the larger degree first. Now, we were accumulate on this thing at between 10 and 15 on a split adjusted basis. It was 100 to 150 at the time. This was back here in 22, 23. And we said from $15 onwards, hold. It's now at 1118 in the post market. So it's been a good run so far. We had an initial price target of 141, that being the 3.618 extension. We dragged that up from 105, the 2.618, and so far it hit that fib extension, pretty much the dollar, and sold off somewhat. So there's two directions I think this could take now. Let's look at the bearish view first. So where NVIDIA could be is in the middle of an ABC correction like this, like so. I just mark this up now. In which case, the stock could drop to 91, mid-80s, and it would still be in an overall bullish pattern. Then you would call this basically a large wave 3 up here. That would be a wave 4 down before a move upwards to finish a wave 5 up here somewhere. So that definitely could happen. Alternatively, you could say that the correction already happened, and why that might be true is if you zoom in a bit, this is an hourly chart. This is the peak, 20th of June this year, and here we see a pretty compelling A, B, C down into the August the 5th lows. So this was a better than C equals 1.618, sorry, better than C equals 1.618A. In other words, that C leg was more than 1.6 times this A leg. That's a deep old sell-off. And since then, the stock's moved up from a low of 90 up to a high of 131. We're currently sat at 118. This 115 level here is pretty important because that's the 38.2 retrace of the wave 1 up from the August the 5th lows to the recent highs. So if 115 fails, and it could fail later as they get into the call, it could fail overnight, it could fail tomorrow, look for the stock to hold at 111 or 106. Below 106 isn't necessarily bearish. If the stock gets below 100, then I'd start to worry. So you can use these Fibonacci charts, and you'll see this in the earnings report in the platform later. That sort of zone there, if the stock falls into this area here, and that's okay. That's perfectly reasonable retrace of this fast move up off the August 5th lows, and all of that I think can be a compelling buying area if you want to add to NVIDIA short term. If the stock breaks below 100, stays below, then that's a deep sell-off. And so yeah, technically you might get a double bottom this 90 to move up, but if it drops below there, something's wrong with the market or the stock. Below 90, there's a big problem somewhere. And that's how I would think about the stock. So ideally it holds over 115. That's true so far, but we won't really know until the stock opens tomorrow, and really will know at the close tomorrow. That's when large institutions who need real-time market hours to sell or buy the volumes that they need to. You can't trade their sort of volumes in post-market or pre-market hours. That's when the news will be properly digested. So tomorrow's close is probably the most important directional signal here. If it closes over 115, I'd be pretty bullish. If it closes over 106, I'd be pretty bullish. Below 100, worried. Below 90, very worried. Time to be careful. And be careful for the whole market, I suspect. So basically, fundamentals really good. We continue to rate it whole. I do not think it's particularly expensive on fundamentals. I do think AI is real. I think we're scratching the surface. I think the stock, as long as it holds over 100, bullish, but really and truly over 115, really very bullish. So that'll be my take. Any questions, folks, on NVIDIA before we move on to other stuff? Abby, you're on.
Alex, can you please explain a bit more about the high margins of NVIDIA, high gross margins of NVIDIA, and the software component to it?
Yeah, I can. High gross margins in general. Okay, let's back up. So what is gross margin? Gross margin is revenue minus cost of goods sold. The pure play definition of cost of goods sold is variable costs. So in theory, if a company has zero revenue, they should have zero variable costs, because variable costs are costs incurred in order to generate revenue. So let's say you had 100 members of staff, and you had to employ 100 members of staff regardless of whether you sold one bottle of lemonade or not. Then the 100 members of staff would be operating costs. There wouldn't be variable costs. If you had 100 members of staff and you had 10 staff who sold lemonade purely on a commission basis, and if you didn't sell any lemonade, they didn't get paid anything, they would be variable costs. And so companies with high gross margins have low variable costs relative to their revenue, and that's an indicator of a high quality business. Why? Because it means there isn't much pay away. If you're paying for distribution of your product, if you're paying third parties for components of your product, you'll tend to have low gross margin. So if you're having to buy in silicon wafers, for instance, to put into your manufacturing plant, then that's going to be a high cost of goods sold. So if you're Intel or Micron or Samsung or any of these companies that have their own fabrication plants, then you're going to have lower gross margin. If you're NVIDIA and you have a so-called fabless model, in other words, you design chips and you send the design to TSMC for them to produce, your cost of goods sold are low. You have monopoly pricing. So because they are, the only game in town, they're a price setter, not a price taker. So they can raise prices on their customers, and the customers can't do a lot about it at the moment. That resentment will accrue, and it'll be stored up, and it'll be used to punish NVIDIA in the future, but not now. And it also means that, again, a key part of why you buy NVIDIA GPUs is the software toolkit that comes with them, because developers know how to write to NVIDIA GPUs in a way there aren't as many developers that can write to AMD GPUs, for instance. And so the value of the software in the selling price is high. And software generally is a very high gross margin business. Why? Because there's no payaways, no components into software. You employ software developers who you pay whether you sell any licenses or not. And so for all those reasons, NVIDIA, very high gross margin. And just to sort of go on about this a minute, this whole time when people have been looking at SMCI and NVIDIA as, the AI stocks to own, SMCI this whole time has a terrible gross margins. Why? Because it doesn't make anything. It just bolts bits of metal together. It buys GPUs from NVIDIA, so a very high cost of goods sold. It buys metal chassis, buys power supplies from other people. It buys cables, it buys packaging, and it puts all that together in a box, and it sends it off to the customer. Low gross margins. So SMCI, poor quality business. NVIDIA, high quality business. Simple.